Hello, welcome to the Money Café. I'm Stephen Mayne, contributor and intelligent investor, founder of Crikey and shareholder activist.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Now, James, Alan's got pneumonia. He's off.
Aww.
So this was meant to be the two hardest working people in journalism, business journalism, having a chat, but instead it's me and you. And your hard work, James, you've just been looking at the Commonwealth Bank result, quarterly, talking to the big boss there, Matt Common.
Yep, it's
what's the hot take?
Well, I've had a lot of it's very hot. It's I just got off the phone, but look, it's I think this is a classic CBA result. If you look at what's happened in the last week with the bank results, so we had Westpac last Monday, NAB on Thursday, and then ANZ on the Monday just gone. What we've seen is a lot of big banks sort of in a state of flux. Westpac's got a new CEO. He's getting his strategy together, making some big changes, and he's chasing this big tech project called Project Unite. So that's Westpac. NAB sort of trying to be the boring bank, but there's this really big question that's come up there about how much capital NAB's got and could that affect the dividend in the future? To be very clear.
Don't cut a bank dividend, James.
To be very clear, NAB says it won't, and everything's fine. And then you've got, at ANZ, you've got Nuno Matos, who's making these big changes in this part of this turnaround plan. The market seems to love it.
Record high yesterday on the share price with Cyclone. Yeah. Nuno's talking a huge game.
I'm a little bit more sceptical. We've seen these big projects. I think people want it to work. They want ANZ to turn around, which is fine. But I think, these 5-year projects will tend to be pretty lumpy and bumpy. And then you've got Macquarie in there as well, who's absolutely hitting it out of the park in terms of their banking business, growing very quickly. But the returns across the Macquarie group are low. And then you've got Commonwealth Bank, which just keeps motoring along. Everyone's trying to copy their strategy. Everyone's trying to be, a version of CBA, but you can't out-CBA. It's a very impressive result. Cost growth has been contained better than its rivals, at least in the quarter. Volume growth looks pretty good. It's a fascinating sort of moment in time because there's people going. There's big changes in banking, and it'll be interesting to see who comes out of this looking strongest.
One thing that surprised me is the whole AI narrative. What the banks are saying seems to be going against it because they're all saying staff costs are going up, above inflation, and tech costs are going up.
Yeah.
Yet the AI narrative is meant to be AI will just save you a fortune because you can get rid of all your staff. Yet with the banks, it's the opposite. They've got ballooning wage bills and lumpy rising tech costs. So where's this AI dividend in our big banks? It's not there.
It ain't here yet. It ain't here anywhere, Stephen. We're not seeing anyone really take out a lot of costs through AI. We're still very much in the experimentation phase. We don't know if it's going to work. The banks are very, 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 very careful about saying that anyone's going to lose their job because of AI. They've got big workforces who they don't want to annoy. So, yeah, you're absolutely right. We're not at that stage, but we'll have to get to that stage. I mean, Westpac's Anthony Miller, the CEO there, he says you basically start the year banking in your costs rising 4 to 5% through a combination of staff costs and, as you say, tech costs from tech vendors who just jack their prices up every year. So, yeah, it's a challenge. We're certainly not at the AI saves us stage quite yet.
No, not yet. And I love CBA, like the home loans, $722 billion, not a dollar in bad debt. And then you've got the deposit coverage. I mean, they're now 79% funded by their deposits, which is just that is the number one. I mean, it's size of loan book and source of cheap deposit funding is their number one secret source, I reckon. I mean, it's just an incredible stat. People trust the Commonwealth Bank with their cash like no one else.
Yeah, but I mean, what's interesting here, I think, Stephen, is I agree that the deposit number is absolutely amazing and the other banks would kill for that sort of thing. But what is interesting is a couple of years ago, CBA had a little moment where their housing market share slipped. And Matt Common came out and said, hang on, you're all focusing on mortgage market share, which is fine, but mortgages do not deliver. They don't deliver high returns. What delivers high returns is deposits. That's where I'm focusing on. And look at the outcome. 79% of his book is funded by deposits.
And he's had a slight increase in his net interest margin because it's just cheap money. So it's amazing. And look, even on business banking, they are closing the gap with NAB, which is number one. They had, I think, close to 10% growth in their business banking. But just looking at their non-performing loans, I think it's $8 billion of non-performing consumer loans, and that's like the credit card sort of side of things. And the total non-performing loans in commercial property, only $407 million. That's not write-offs. That's just loans where the property developer is not actually servicing the loan at the moment. And that says that they're growing their business lending without taking risks on property developers, because it's private credit and all the other players, even like Jerry Harvey and James Packer, and those types are getting into the private credit, funding buildings, funding property developers, because the big banks are still not getting into that risky property development game. But in the CBA's case, it's not like they're totally avoiding the business sector entirely. They're actually strongly growing their overall business lending books, but to quality corporates who pay the money back.
Yeah. No, absolutely right. They've done a pretty cracking job across the board. And I think that's the thing about CBA. They just don't make too many mistakes. It's a sort of underestimated quality, that.
Yeah, and it's funny, they made the most amount of mistakes that caused the Bank Royal Commission.
Totally.
And then it's almost like they were in the naughty corner. They probably wouldn't have had the Royal Commission but for the various scandals within CBA. And then since then, under Matt Common, they've actually had the least amount of scandals. I mean, poor old ANZ, got the $240 million fine for, not being straight with the federal government on their bond issue dealings, and amazing how they cut the bonuses of the ANZ brass by $32 million using board discretion, including $13 million in cut bonuses for the former CEO Shane Elliott. A big use of board discretion because of things like fines and issues in the retail bank and regulatory issues. I thought it was very interesting. Whereas at CBA, none of that stuff is happening.
No, that's true. I think at ANZ, that big hit on Shane Elliott's bonus was probably a bit of catch-up. I think investors wanted to see a bit of that last year, and you'll remember, I know you're an AGM aficionado, and ANZ got a strike last year. So I think there's a bit of catch-up in that figure. But it's really, it is really interesting that we are seeing some really big shifts in banking. I think we need to keep thinking about this.
I thought it was quite funny, actually, because the boards are very brave at cutting CEO bonuses after the CEO has left.
Yeah.
I mean, Alan Joyce, $10 million cut. It was quite funny. At the Qantas AGM on Friday, I lobbed in a question to the chairman, John Mullen, about what he thought about Alan Joyce doing a book.
Yeah.
Is he worried about the Qantas personnel being sledged? Have we sent him a stiff letter yet asserting our rights on privacy? Did it come as a surprise? And he said, look, I found out about it when I read it in the paper. So, and I hope Alan doesn't have a go at us, but he's a private citizen now. He can say what he likes. Yeah. And I guess having had $10 million cut from his bonuses, I think he'll be coming off the long run, I suspect, when his book comes out next year.
So, Stephen, how is AGM season treating you? Have you any sort of really memorable stoushes or any patterns or trends we should be thinking about?
Oh, look, I think there's probably been more protest votes than I was expecting. Like quite a lot of REM strikes. Obviously, you had the James Hardie situation where, the board got cleaned out, including the chair. I mean, even like Woolworths got probably the most vicious flogging from the floor, and 34% vote in favour of the shareholder resolution because of the way they're behaving with their Tasmanian salmon sourcing.
Yeah.
And literally, when I jump off the call today, James, I've got the Coles AGM at, would you believe it, 9 o'clock at the Melbourne Tennis Centre on a wet and miserable Tuesday morning. So I can tell you that these companies, they work hard to make sure no one turns up, and there'll be very few people at the Coles AGM. But I'll be working from home, and they'll also have a big debate around their salmon they got the similar shareholder resolution to last year, again, when there was 30% protest. So you've got some of these sort of ESG type issues. They've moved away from like coal and climate, and Coles and Woolies are the number one targets in terms of ethical sourcing, wood chips and beef sourcing, and salmon's the big one. But that's quite interesting. And I think I enjoyed going to the Channel 9 AGM, your AGM last week, where they were very happy not to get a second strike. It was only 18%. You had a chair transition there to Peter Toner, which is always interesting. I love asking questions about how did you find the new chair? And I got Peter Toner to declare that his long career at News Corp was not an issue when he'd sold all his News Corp shares, his RBA shares, and he was a totally independent new clean skin chair of Nine, and he's got a lot of deep expertise in media, so he'll be pretty good, I suspect. But look, it's going to be interesting in the next few weeks. I think I've got 17 board tilts happening in 18 business days coming up. The most interesting will be Myer, where their notice of meeting came out a couple of days ago, and they've done a sneaky. They've scurried off to Sydney for a 9:00 start. So Melbourne-based company, and I'm running for the board. I suspect that's a little bit of making it difficult for me. They've completely censored the platform. They haven't even told the shareholders why I'm running. So I'm a bit annoyed about that. But and then we'll finish the season in terms of AGMs. All the big banks, three of the big ones, have their AGMs in the 2 or 3 weeks before Christmas. And good old ANZ, they're running off to Sydney too with a 9:00 start. So I was looking forward to fronting Nuno Matos in Melbourne, but no, up they go to Sydney. And the best one for rotating the AGM is, tell me which sport you think that Paul O'Malley, the chairman of the Commonwealth Bank, particularly likes. So three of his 4 AGMs have been won at the MCG, the Adelaide Oval, and the Gabba.
Is he a cricket fan?
He just might be. The Dubbo boy just might be a cricket fan.
Well, to be fair, I guess CBA is a big sponsor of women's cricket, so maybe there's a link there. I don't know.
He is on the Melbourne Cricket Ground Trust, so I suspect that might be it. But never before have we seen a major company do such a national tour of the iconic sporting field. So I presume it'll be at the WACA next year, and it works well because no one turns up. It's hard to get to. They're short meetings, not many questions. So I suspect that might be the one of the reasons why they go to out of the way sporting venues, early starts, and not many shareholders turn up, and you have a good quiet meeting, as the CBA did, because they're performing so well. No one's having a whinge at the CBA, and the activists at the moment seem to be all over Coles and Woolies instead.
Yeah, no, that's interesting. I hadn't heard about the big salmon push, so interesting.
Yeah, and now we've got to talk about the markets overnight, James. We've had the S&P's up 1.5%, and the Nasdaq has bounced 2.3%. So all those wobbles of last week, is the AI bubble bursting? Well, it's they basically recovered most of what they lost last week in one session. And the Nasdaq's now back to sort of being 2% away from an all-time high. So that's a long way from the AI bubble bursting.
Yeah, look, I don't know. This is a weird one to me. That the narrative last night, on Monday night, was that the US government shutdown looks like it's coming to an end, and so markets rallied a bit. I mean, markets didn't care about the US government shutdown at any point in time, so I'm not sure why they should be excited about it ending. But yeah, I think there was just a bit of buying of the dip. I don't think the AI bubble debate is going anywhere. That is still the only thing that matters in markets. And I think it needs to rage on. I think it's very healthy. We're going over every aspect of this AI bubble with a fine-tooth comb. It deserves to be debated. 40% of the S&P 500, the market that matters most in the world, is now in AI stocks. If this thing falls apart, it's going to get very ugly. So, we need to keep talking about the good and the bad of AI. I think it's really important that we keep debating this.
I agree. And I have to say, speaking of shutdowns, yeah. I mean, don't forget it's 50 years since our shutdown was ended.
Yes.
When the only time we've ever had a serious shutdown debate, and Sir John Kerr came in and went bang. Maybe the Americans need a little bit of regal intervention, and someone come in and sack Trump, get the government reopened and call an election. I mean, Sir John Kerr would be the perfect man for this situation with this longest ever US shutdown, surely.
Plenty of nostalgia journalism this week, hey, Stephen, hasn't there? It's been interesting, I must say. It's always interesting when a lot of several of the key players are still alive, and there's some great reflections. I think it's been it's been interesting to see people still tying themselves in knots about this 50 years.
I know, exactly. Now, before we get to the question, we probably should just quickly cover the interest rate situation and the RBA. I mean, they're a little bit boxed in at the moment, the poor old RBA, aren't they?
Really interesting choice of words by Andrew Houser, and he's sort of explaining what I've been writing for a little while now, and lots of other people have been writing about. The problem is this is where our problem of crappy productivity comes home to roost. Every time the economy starts to grow, because productivity is so poor, inflation's going to kick up. That's it in a nutshell. So poor productivity equals higher inflation, equals higher interest rates, and lower standards of living. That's the problem we're facing.
And it is interesting. The US are actually on the opposite side, where they've got more. Better numbers on inflation. So they're still seriously talking about the December rate cut. You've obviously got all the Trumpists pushing for that, but they haven't had the shock jump in inflation that we've had. They still think they've got inflation nicked, and they'll deliver the rate cut. So that will be interesting as well if the US come through with another. But then again, can you cut US interest rates when you've got this crazy AI bubble with asset prices through the roof? That's the other thing. It's like our housing bubble. Can you really cut interest rates again when you've got this crazy housing affordability bubble?
Great question. I saw an interesting line the other day that suggested, the problem. We saw this election in New York City. Zoran Mamdani won, really again like Trump, because inflation's so insidious for voters. They hate it. But how do you cool inflation? How do you tame inflation with stocks at record highs and house prices at record highs? You don't. You just don't. So, I mean, this is an interesting question to be posed. Like, is the rising stock market actually bad for Trump in a way? He thinks it's the greatest thing ever. But is it bad for him because it will never get rid of this inflation problem? I mean, his approval ratings on the economy and inflation are terrible. This is why you're starting to see Trump talk about, capping prices in pharmaceuticals, in utilities. He's going after insurance premiums.
Oh, insurance. Overnight, he was ripping into all the US insurers for ripping off consumers, and the insurance stocks have all tumbled overnight. He's been ripping into the air traffic controllers. Get back to work. Let the planes fly. Yeah. So he's sounding he's always sounding rather brittle and way out. But, he's got a heck of a cliff top to navigate in terms of all the things that they're juggling at the moment. Now, James, we better do some questions, but before we do that, let's have a quick word from our sponsor.
Looking to build your investing confidence and discover new ideas? Join Intelligent Investor at ASX Investor Day in Melbourne this Saturday, the 15th of November. It's a full-day event packed with practical sessions from leading investment experts. Catch Intelligent Investor's Deputy Head of Research, Gaurav Sodhi, on the top investment ideas and stock picks panel. Tickets are on sale now. Just Google ASX Investor Day. Make sure you use the code NOV25 to get 20% off your ticket.
Now, Nick says, James rightly pointed out on the Money Café last month that it's highly unlikely Australia will be able to rely on iron ore exports to China for the next 30 years to prop up its economy, as it has for the past 30. It would be fascinating to peer into the crystal ball of a bearish Thomson, a bullish Mayne, and balanced Alan Kohler to answer this question. Just how might Australia's exports and economy in general look by the 2050s? Will we be able to sufficiently fill the iron ore void with critical minerals or through other means? How might Alan's three favourite focus areas of housing, climate and AI look by then? Well, James, Captain Balance is off crook, so let Bear Thomson go first. What do you reckon?
It's just so hard. I mean, it's hard to see what's going to happen in, the end of 2025, let alone 2050. But I think we have to prepare for iron ore prices to start to drift lower over time. They're not going to be, steel production in China has peaked, so that means the amount of tax revenue that we've got from selling iron ore to China has peaked as well. I'm not saying the iron ore business will still be going in 2050, no problems, but it won't be a bigger part of our exports. Will critical minerals fill the void? I'm not sure. Critical minerals aren't as rare as they sound. It's the processing part that's rare. But look, we can build a business in that. Is it big enough to sort of rival the iron ore complex? I don't think so. And as for housing, well, I really don't know. Surely house prices can't keep going up. But again, this is the problem I just referred to with the stock market. You don't tend to get a rebalance or a resetting of house prices or asset prices without a big moment of pain, like a recession.
Shock, a black swan event. Yeah, that's right. You don't get those big changes unless something dramatic happens.
It stands to reason we'll have something dramatic happen between now and 2050 for sure. And I think it comes from those last two, climate and AI. We've got no idea where that's going. The climate puzzle is very tough. We're going to be, as Alan has said, we're going to be moving more towards adaptation and resilience.
Yeah. I don't think we'll have reached net zero by the 2050s. I'm going to make a prediction and say I think that China will be a democracy by the 2050s, and that'll be one of the biggest changes. We'll still be talking about the day, November 30, 2022, when ChatGPT revealed OpenAI revealed ChatGPT. So I think that will be still talked about as a moment. So the whole AI thing is going to be a big long-term trend. We might have got our first AUKUS submarine by the 2050s. Transurban will have handed back a few toll roads to governments by then. That'll be a good thing. And everyone will be shooting around in self-driving cars. We'll be jumping in our self-driving cars, and that'll just be such a normal thing. And people will talk nostalgically about driving themselves like we talk about black and white TV. So that'll be one of the other big changes by 2050. But with Rio Tinto opening one iron ore mine a year, there will still be a very large iron ore business in Australia in the 2050s. And China, doing 1 billion tonnes of steel now, 10 times more than any other country, will still be easily the world's biggest steel producer. And there'll be a lot of big boats going to China from the Pilbara still.
I just love the fact you got Transurban in there. Well done. All right, Peter says, long-time listener, first-time questioner. I don't agree with Alan's analysis of investment versus return on AI spending, as surely AI will come up with incredible breakthroughs, including medical advances, cancer treatments, dementia care, better antibiotics, new materials and better batteries for solar panels, more accurate weather forecasts, which will save lives, climate change modelling. When all of these are monetised, the return will be in the multi-trillions, not to mention the unquantifiable benefits to mankind. In light of these breakthroughs, would you be prepared to reevaluate the economic returns from all the AI investments?
Oh boy! Well, Peter is latching on to Jared Minnick, who is he's long been a bear on a few things, and he's come out with a bearish perspective on all the big tech AI investment, which Alan has been talking about, saying that there's no way you can get the revenue returns to justify the spend. Now, the spend is about US $400 billion a year at the moment. I think the only issue is actually OpenAI. They are the only one that's actually losing money. I think actually Microsoft just needs to buy OpenAI. I mean, they already own about a quarter of it. That is everything OpenAI is doing. That's the thing that doesn't make sense. You can't do $1.5 trillion in contracts when your revenue's $13 billion and rising fast. So that's the canary in the coal mine, OpenAI. Sam Altman's lost the plot. He's been making a few silly comments. People are starting to go, what's going on? But the rest of them, it's just going to be a great bolt-on to enterprise software. I mean, Google Cloud and Gemini chatbot. Google shares are up. Alphabet shares are up 50% this year. And a lot of that is the upside from enterprise software and bolt-on benefits from AI and these sort of things. So I think it is going to be a huge return.
But Stephen, what benefits? Like what we're seeing out of these? I'm just to play the devil's advocate for a moment. What we're seeing out of ChatGPT, Gemini, at the moment, they're basically souped-up internet searches. You know, the AI agent goes off and collects a bunch of answers from the internet that you would have taken you 30 minutes to get yourself. Now that's good, I guess, but it's not more accurate weather forecasts or discovering new medicines. I think Peter's what we're the problem we've got here, and this is what Minak's getting at, is the time frames are different. So all this money is being spent right now, but all the benefits, all these big breakthroughs, are probably things that happen over the next 10 to 20 years. Now, that's a long time in markets. I mean, 3 days is a long time in markets. So we will get a moment where people say, hang on, you're spending trillions of dollars now, but I'm not going to see the monetized benefits and returns until 2040? No, thank you. I'll buy your shares back. I'll sell now and buy your shares in 2040 when you're actually getting something out of this. That's the problem. It's the mismatch of timing.
Yeah, but that's an attack on the companies doing the spending at the moment. And Peter's point is more about the application of AI across all markets and medicines. And I agree with him. I think that the upside, the productivity upsides, the benefits, the efficiencies, the
buying for that now. I mean, this comes back to your point earlier about the banks. The banks are the biggest users of AI in the country. There's got nothing to show for it.
Yeah, I don't know. I just get there's a whole bunch of US stocks. It's not just the big tech. I think the problem in Australia is that we're just very slow at adapting to it, and we're just not very innovative because we're just a big quarry. And with a few big banks that are a bit of an oligopoly that clip the ticket on housing and residential and this sort of stuff. So I think that's more an indictment of us. Rather than, and the fact that the US has got all the vast majority of the innovation, the startups, the billion-dollar companies that have only been around for 3 years, innovating on AI. I mean, Lemonade, the insurance company, their shares popped last week because they've put on so many new insurance customers and they've slashed their staff. So they are actually embracing AI, taking market share, making profits, watching their shares go up. Because insurance is ripping through AI. But what are our insurers doing on AI? Not much. We're all a bit sleepy. You've got the power of the unions. You don't want to upset the workforce. Politicians nervous. So we're not leaning in as users of AI particularly. And I think that's probably one of the problems. Compared to the US, we're sleeping through this.
Yeah, not sure I agree. But look, I think if Peter's right, he has to. His argument has to defy every CapEx boom in history. And
yeah.
Peter, I think I'll take history over your argument. I mean, I think you're right. All those things that you're saying will happen. They will happen over a much longer time frame than we expect.
Yeah, no, fair enough. Now, Pat says, I'm retired and lucky enough to have cash available in my reserves in my SMS, but I'm still awaiting this possible AI correction that I expect will pull the rest of the market down. And when this happens, creating big buying opportunities on the dip. Do you see any standout stocks that would be worth pursuing in such an event that may perform better than others? And of course, James, we don't give financial advice, do we? But what do you reckon? Diamonds in the rubble that have been ignored in the AI bubble?
I think it's really look at where the ASX is trading. It's never been more expensive. So I don't know where the diamonds in the rough here are. You know, you got Wesfarmers and JB Hi-Fi trading up near all-time highs. I find it hard to see lots of pockets of value. I think what usually happens in moments like this is everything sells off. If there is a big AI pullback or an AI correction, you'll see everything sell off. You don't need to look for the diamonds in the rough. You just need to look for the quality companies with the wherewithal to get through it. Yeah. Like if there's an AI correction and Microsoft shares are down 20%, is Microsoft's a lower quality business? I'm just picking a name at random, but
yeah,
I think that's the thing about a big correction. You'll get a chance to buy the best companies at better prices.
And the other thing is, if there really is a serious meltdown, like the 2000 tech crash, the first question you ask yourself in terms of what you're investing in now is, will this business survive? Will it have the balance sheet to get through that? Will it be Macquarie, which can survive the GFC, or will it be Babcock and Allco, which literally collapse with the GFC? Will it be Rupert Murdoch and Dick Pratt, which can survive Paul Keating's 17% interest rates and the recession we had to have in 1991-92? Or will it be Alan Bonds, Skase, Spalvins, George Herskey, and all those entrepreneurs who got cleaned out by that? So don't be exposed to companies right now at the top of a bubble that could go broke, that could get totally wiped out by some sort of black swan event. And then, I agree. Just wait for the overall correction. And I think it needs to fall at least 10 or 15% before I'd be putting any serious money to work. But a lot of people have been sitting on the sidelines with cash, putting it into the Commonwealth Bank, not getting much back. And it's the correction that's never happened. So
That's right, yeah.
How long can you sit this out when, it's been a long time since we had another sort of meltdown. I mean, I guess we had the COVID crash of 2020. That was an incredible buying opportunity.
Well, the S&P 500 did fall 18% in April. So
that's right. It was a mini crash because it was so quick.
Yeah.
Until Trump said buy on April 8, and then bang, by the end of the month, basically it had recovered it. So.
Yeah. All right, Matt says, responding to your recent comments on housing affordability, in Sydney, the prospects for a young professional couple to afford an average standard of housing, i.e. somewhere convenient to where they work, without family assistance are beyond bleak. Whereas I advise baby boomer clients who work traditional average earning occupations and are now wealthy through housing and the growing success of super. At what point do young people revolt against generational inequality?
Well, I mean, I think bullseye. I think Matt's got it in one, that middle income tax rates are too high in Australia. If I was Prime Minister for a day, you'd be getting rid of some of the tax exemptions on everything from the family home, inheritances, churches, etc. You'd be increasing taxes on iron ore, royalties, that is, capital should be taxed more. And I actually asked the boss of listed developer Cedar Woods at last week's AGM what he would do on housing affordability if he was planning minister for a day and housing minister for a day. And William Hames, a rich lister in Perth, who's got 35 housing projects going nationally at the moment, he said he would get governments back into direct supply through construction and ownership of affordable housing. And I agree with him. It's the one thing that hasn't been tried is serious material government investment and ownership of and management of affordable housing for people who are suffering through this crazy housing price affordability crisis. What do you reckon?
I think that's not a bad idea. But I think just to come back to Matt's question, at what point do young people revolt? I think we saw an example of that with Mamdani in New York. He was carrying the victory on Gen Zers and millennials, and lots of people have had a go at these voters saying they don't get that the policies he's putting up, like rent control and city-owned grocery stores, they're economically stupid. People, when you're locked out of the housing market or you're spending 55% of your wage on rent, which is the average in New York City, they don't care if the solutions are dumb. They just want something. And I think politicians, investors, and CEOs need to look at that result in New York and think that's what's coming. If we don't get solutions to this stuff, careful, thoughtful action, then we will get politicians elected who want to do crazy things. It's that simple.
I agree. I absolutely agree that Mamdani, it is a warning to everyone. And the populist revolt, it's been more seen on the right with an anti-immigration anger. We've seen that globally, but it could absolutely come from the left and with tax the rich and give it to the battlers sort of policies. And that worked a treat for Zoran. And I think you'll see more of that being rolled out. Now, we've got time for one more question each. I'm going to jump to Dylan and say, as Australia's population ages, will retiree withdrawals from superannuation eventually exceed contributions from workers? And could that shift trigger downward pressure or a correction in investment markets?
Yes, there should be a moment in the distant future where we do get the system in deaccumulation rather than
rundown mode. So, but it's been running up to 4.4 trillion like a rocket, and it's got a few many years to go of net increases in that massive pile, isn't it?
And if you talk to some of the big funds, they actually think that moment of rundown is actually further off than you think, because we could see fund mergers, consolidation in the super sector, all sorts of things. So I don't think it's definitely not a near-term worry. I don't even know if it's a long-term worry.
Yeah, because 12% is a huge amount of mandated cash flow, and people are basically they're not running their super down. They're just living on the earnings, and their super's often staying the same and going up. So people are not taking their money out of super and spending it down to zero. It's just not happening. I'll let you choose the last one, James.
Well, I'm going to go back to one for you, Stephen, about AGM season. This is right in your ballpark. Stephen's often maligned retail investors that don't attend AGMs and don't ask questions. As a retail shareholder, one of the challenges is getting a calendar of when the AGMs occur, how to access them virtually if possible, and how to ask questions. To date, now James says he's asked some questions at CBA's AGM as well as a number of upcoming AGMs. To date, the answers have been vague and politician-like. As a shareholder, how can I truly hold the board accountable?
Well, look, James is onto a good point there. He's got a good point is if you get involved with the pre-AGM question, because a lot of the AGM notices will, even online and in paper, will say, have you got a question? Send in your question. And that just gets worked over by the PR people and into a scripted response. So much better to ask live questions at the meeting to test how good the brass are. It's like watching someone be interviewed on the 7:30 report. You want to see how good they are at answering live questions, not just getting some script. So I would recommend trying to get the live questions going. At doing it online, I mean, I'll be throwing in questions at Goodman today, at Coles. I'll be doing 250, 300 meetings this year, all because of the benefit of live meetings. And I do agree with him that calendars are hard to find. Like I spent half my life maintaining the AGM calendar, and some companies actually go out of their way to make it difficult. The good old News Corp, the Murdochs, they've just emailed me this morning. They've finally replied to me and sent me my 12-digit code to access the meeting at 4 a.m. on November 20th, the virtual meeting. And of course, they'll be running a 2-question limit. So News Corp makes you pre-register 7 days in advance, or it's a lockout. And whereas other companies, you just put in your HIN number and away you go through Computershare or Link. So, but look, good on James for actually asking some questions, getting involved. More people should do it because it's the one day of the year that retail shareholders get their day in the sun.
Yeah.
No institutions, no analysts, no brokers, no fund managers, just the retail shareholders, and too often not enough questions. So get involved, lob questions, do it live. And let's have some accountability and shareholder democracy in Australia, James.
Don't be discouraged, James. Keep pitching up like Stephen does, and it does make a difference. I tell you, the best questions, Stephen, asked at the Macquarie AGM were by you, and we got some great responses from the chairman. you absolutely made my story that day. So keep pitching.
That's because I normally email or ring up the journos who know what they're talking about and say, hey, I'm going to the Macquarie AGM tomorrow. You got any good questions? I do that more often than you would realise. So working with the journos, but no, it's a good look. Anyway, thanks for listening to today's episode of the Money Café. I'll be back on deck next week with Alan, who will be recovered from his pneumonia. So send in a question and we'll answer it together by emailing themoneycafe@eurekareport.com.au. Until then, I'm Stephen Mayne, contributor and intelligent investor, founder of Crikey, and annoying shareholder activist.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review. Talk to you soon.